Afternoon, folks. It's Algo Factory. It is the beginner lab free on YouTube. And if you're watching us right now and you're not joined to algofactory.tech, you need to get over there to algofactory.tech, join us, and learn how you can trade your job and upgrade your life. AlgoFactory.tech. We're the place that's going to teach you how to be free, how to be a more better, more proficient, more effective trader in an industry and a business that could absolutely change the course of your life. And with that being said, we have the professor here live in studio, the one and only I almost said crypto. Algo Cowboy is here. What's up, Al?
Yeah, taking it back to the crypto days.
Yep.
Yeah,
Absolutely.
I had to pull a P Diddy. Had to do a name change there. When I really started to move over to Forex, I still trade crypto. Don't get me wrong, but I focused on Forex after about 2019. So I figured, Crypto Cowboy was the thing back in the day, and now that I've been focusing on building the algos, we have the new name.
Absolutely.
Yeah. So how you doing, man?
Good, man. Just hanging in there. Call after call this morning. I started at 7 a.m. And it's gonna be one of those days, brother. It's gonna be one of those days. It's gonna be one of those weeks.
Nice. All right. Well, that's. I mean,
Well, that's good though. I'm not complaining.
Yeah, I was just say if you get the calls and all that, it means you got business going on, right? That's a good thing.
Yeah. I got business. Got some intel. Hopefully, I'll have some intel this Thursday. So if you're in AlgoFactory.tech, you're gonna get the juicy bits right into the members lab. So it's going to be pretty awesome. So join up. There's stuff that we say there that I can't say anywhere. And with that being said, yeah.
Yeah, tomorrow is the juicy day, right? You're going to drop some whatever tidbits that you might have hidden away for us.
Whatever I get the clearance for, I'll be able to share that.
That's good. Well, anything? Let me take a look to see if anybody has any questions. Yeah, Valley Girl says, "Where is everybody? You're late." I'm gonna say I'm blaming the gorilla. All right, so if you guys are in the chat, either YouTube chat or in our private chat, go ahead and ask questions. I did have some subject matter to cover today, possibly, but first I wanted to make sure that anybody's questions actually got answered first. So, we're going to talk, while anybody might be, thinking of questions to ask, I want to talk about bias today. And, one of the things we've talked about in the past, even before I was involved in doing shows on Rogue, shortly before I got involved back in 2018, was normalcy bias. So I know, V, you know all about normalcy bias.
Oh,
so
yeah.
You want to give us a little overview of that?
Yeah, normalcy bias, for those that don't know, is things will stay the way they are. Everything's normal. Everything's fine. There's no abrupt, massive change. No paradigm altering event that's going to come and absolutely take a dump on your worldview.
How eloquent! Thank you.
You're welcome.
It's true though. I think one of the normalcy bias, I think, that is going to cause a lot of people to. And again, none of what we say on here is investment advice. Please consult your licensed investment advisor before risking your money on markets, because you can lose your money by doing so. One of the normalcy bias, I think, that's going to cause a lot of people to miss the bus is what may happen with precious metals in the next anywhere from 6 months to 5-10 years. I do think precious metals have a bright, shiny future. And it's hard to say when it's going to happen, but there was an article yesterday on Zero Hedge talking about the central banks have been buying precious metals at a clip that is it's orders of magnitude higher than what we've seen in the prior 60 years. I think it was like 2018 or 19 when the central banks bought more money in that year than they all had in the prior 60 years, if I remember the data correctly. So if you're thinking about it, I mean, the central banks get their orders from the BIS, which is the Bank of International Settlements, which is the central bank for central banks over in Basel, Switzerland, which was put together initially to kind of broker deals with the Nazis after, post World War II. So to kind of ensure that the debts were paid. Actually, was it World War One, pre-Nazis, right? Wasn't it?
Yeah,
It was to broker the payments from the Weimar Republic, if I'm not mistaken.
correct.
So, and then out of that kind of sprung this. I mean, it's a big, long history. We've done the history on the Rogue Show about 4 or 5 months ago. We went over that history. So, it might be good to brush that up another time. I don't want to talk about it too much right now. But the normalcy bias, where this comes in, is, look, gold has been kind of hitting its head on 2000 for some time. And the West has had some modicum of control over the price of gold, because that's just the Western financial system, the dollar hegemony, the markets, all that was kind of set in London and New York, and actually I think there's some control over in Chicago too. But the COMEX has been holding the price down. And the fact is that the COMEX is actually running out of physical gold, we think. And I think we're actually, do we know that that's going on, V, or is that just what we think, that they're running out of gold?
No, they are. I mean, they say they're running out of gold, but they always resupply.
Oh, I see.
So are they settling? Are they doing something so crazy as to settle contracts? Like a couple months ago, they settled 110,000 ounces. Yeah, they're settling contracts in physical and demanding delivery. It is happening. It is happening. So there is something going on in the COMEX, but in terms of them running out, no, they're not running out. And the reason for the reason why they're not running out, they're buying right now a massive amounts, because there are trades that are happening on the COMEX that are being settled in physical, and it's not just a movement from one ledger to another ledger. I'm not talking about crypto terms. I'm talking about from one balance sheet to another balance sheet and saying, hey, okay, we took gold ownership. It's not like that anymore.
Yeah, you're not just you're not getting some allocation by by the virtue of a piece of paper saying you
Correct.
have an allocation. At this point, they actually need to purchase the gold.
Yeah, there's been quite a few physical deliveries that have occurred. That's a fact.
Well, if you think about this, if physical deliveries are going up, and even the CME is purchasing,
Yeah.
look, you can't continue to purchase something that has scarcity like gold without the price going up. And yet, people, this is where the normalcy bias kicks in. Nobody's buying gold. Like, I mean, you have people that are buying it, people in our group, people that, and kind of more of the, you got the preppers, you got the people who are just not trusting the banking system. You have some people who are ahead of the curve in that manner. Yeah. I'm not saying like being a prepper is like the best thing to do, and maybe it is, maybe it's not. Make your own decision there. But what I am saying is that the normalcy bias is where most people is that gold and silver, there's no use of buying it. They'd rather hold their cash. They'll buy stocks. Stock market good. Gold is a barbarous relic. And I think that normalcy bias, because that's the way it's kind of been in the short term, if you don't zoom out, if you don't look at the history of gold, it doesn't move that fast compared to like, oh, I bought Tesla a few years ago at whatever $100 and it went up to 1,200. Like those kind of opportunities are not necessarily there with gold right now, and so that's, people just don't associate gold with like making lots of money, and that's very short term thinking, and that's a normalcy bias kicking in. And if events happen like they may happen, where everybody's buying gold up, and in the next few years, I mean, look, you can't just keep buying something scarce and the price stays where it is. You can't do it. There's no way to continue forever to use the paper machinations to hold it down. So that's normalcy bias. Okay, so trading is something where, in the end, a bias is not good in trading. Okay, so what do I mean by that? Well, there's a number of biases to which traders can fall prey, and it can cause them to make decisions that are not logical, that are not based on the data. So, that said, There's a lot of questions going on about gold in Russia now that we've sparked that conversation. It doesn't really have a lot to do with trading, so I can I'm going to let our private people just talk about gold if they want to. But we want to talk a little more about more bias. I think we want to introduce the beginner traders to some of the pitfalls that happen, and this is going into trading psychology, right? So there's something called, and I think this particular bias is very key to like crypto people, that they just have this crypto coin that they think is going to save the world, and then they actually made some good money on that coin, and so they never want to sell that coin.
I'm holding Pepe forever, baby.
Yeah, that's like, I mean, if you are in crypto and you've been through a bull market, or you happen to catch some crypto as it went up really high, like you think that crypto is everything because it made you money. There's people who've made life-changing money by just getting in the right crypto at the right time, and that crypto was nothing. It was vaporware. There was nothing to it. It's not going to do anything. It never will. That's like 99% of crypto, if not more percent than that. But they love that coin because it made them money, and that is a bias. That's when that coin is going up, that's like a confirmation bias, right? That's kind of what that's called. So, for example, people hold some trash coin from 2017, right? They bought it at $50 and it goes down to $1, and then all of a sudden it goes up to $5, and like, see, I told you, see, that's confirmation bias. So that they've had like a 90% loss, and then they get this move back up to where they can recover just a little bit of that, and it's like, oh, I'm never gonna sell it, and so they think it's gonna go. Oh, look, maybe it will. The next bull market hits, your shitcoin goes up really high. That can happen. I personally wouldn't bet on it. If I were, having been through 2 bull markets in crypto, which is more than the vast majority of people can say, I would say that outside of your top like coins like Ripple, Ethereum, things that are kind of very supported by either the establishment, or pretty much the establishment, or outside of something like Monero, which is heavily community supported. If there was a project that didn't have any real support back in like the last bull run, and I had bought it and then I held it and I had it even right now, I would be looking to, outside of one of those big coins, I'd be looking to get rid of that and look for the next kind of thing that's going to pop up, or put it into something solid. And of course, that you're realizing a loss at that point to do that. But I'm telling you what I would do. You got to make your own decision. But that confirmation bias is what keeps people from doing that. So you bought that coin at $50, goes down to $1. It's a trash coin. It might only go up to $4 or $5 on the next bull run. And then you thought it was going to go back up to where you bought it at, and it never does. But you love that coin because maybe you bought it at 25 and it went up to 50, right? And then you never sold it. So, I doubled my money back then. Well, holding on to that coin is a form of confirmation bias. So there's that. There's recency bias. So this is really key. Once traders get into a situation where,
hey man, you're exposing all my biases.
Oh yeah, well, that's bigotry. That's racist.
So racist.
Bias is racist.
To say that Pepe coin is not going to go to the moon and become a $5 coin, that's racist.
It might. Pepe coin could go. Hey man, Pepe coin could go to the moon. Any coin can do anything, and no one knows the future, right?
So far, it's down 10%. But...
yeah, well, I mean, but you're playing a different game, right? So, you're not playing I'm going to buy this and sell it. You're going to play a game, I think, and you haven't really actually talked about what you're doing with Pepe coin, but I'm assuming that you bought it with the intention to kind of wait for the next large crypto bull run, and then maybe sell it during that time.
Oh, absolutely. I'm not holding on. I can care less about it. It was like play money. If you got play money to play with, take a little gamble on your own discretion. It's entirely up to you folks. But yeah.
There's something like that you might have to sit on for a long time. Pepe coin's new. Like, people have a bias with Shiba Inu coin.
Yeah.
They have that bias, and part of it's because they own that coin. Part of it's because it made some moves back in the day. a year or two ago, and they made some money on it, but then they held on to some of it, and people say, "Oh, Shiba is good. It's a burn. It's what's the word? It's deflationary." And like, dude, there's like a trillion of them. I mean, I'm exaggerating, maybe. I don't know. I'd have to look at the market cap, but there's just a lot of coins out there like that. So, but recency bias is another thing. Okay, so recency bias is it can happen in any market, and it's when you are trading actively, and you could be a swing trader. It doesn't really matter the time frame, but if you have a system that you've actually tested, you have an algorithm that you've built. And remember, don't be scared of the word algorithm, my beginner friends. All an algorithm is just a system. Okay, it's just conditions A, B, and C are met, and then you take action. That's all it is. Driving a car, getting to the store is an algorithm. You take this right, you take this left. It's not a big deal. And once you've built that and tested it, and you've gone back and back tested, and you've forward tested, you've actually taken a bunch of live tests, and the statistical probability, of having this hit rate and having that risk to reward ratio. You have something called expectancy. Every time you click that button, you're going to make a certain amount of money, right? Well, what can happen is that the market can go through a period where most of the periods I see in the market are going to be volatility related. So you might have a period of high volatility, then you have a period of low volatility, and people get real streaky. So it's like maybe your algorithm is affected by volatility. So you have this volatile time where you're winning every trade, and that you're supposed to win 7 out of 10 trades or whatever it is, right? But you win 20 in a row, or you win 18 out of 20. You start to think you're God, and all of a sudden, like, oh man, I'm winning all these trades, right? So, well, that's a recency bias, because when those conditions revert, you're going to probably come back to that statistical, norm that you're used to of winning, say 7 or 6 out of 10 or whatever it is that you win. But you're winning you're winning 9 out of 10. Like, oh man, I can't lose if I just, maybe I'll just put a little more money, right? And it almost happens. It almost, without fail, that one trade where you double your entry or triple your entry, when you augment your position size and you put more money, that's the one you lose. That's almost always the way it goes. And that's a recency bias. So recently you've been winning 9 out of 10 or 10 out of 10 trades, and you can't lose. You're like, all right, the mistake is falling prey to that recency bias, because in the end, the numbers catch up to you. And it doesn't mean that, this is where the gambler's bias can actually come in, right? So there's something called the gambler's bias, where let's just say we're flipping a coin, right? And you got heads 10 times in a row. And you're like, man, I know the probability of getting tails is like 50%. So if I've gotten a bunch of heads in a row, so that tails is coming. It's got to come now. Like, that's a gambler's bias. Every time you flip the coin, the probability resets. So applied to trading, what this can look like is a situation where, okay, I've won 8 times in a row. I know that loss is coming because it's, I'm supposed to, let's just say 18 times in a row. So I'm supposed to win 7 out of 10, but I'm winning more like 9.5 out of 10 or whatever it is. So, I know that loss is coming, so I don't want to take a trade. And that's kind of the opposite of the recency bias in a way. But that's also BS too, because your probability resets every time. It's like looking at that roulette wheel, right? And that on that roulette wheel, it's like, man, 9's been hitting. 9's been hitting all day. I can see it because they have there's like a screen above roulette that tells you what's been hitting all day. So, man, 9's hitting. So I'm going to bet on that 9 because I know it's going to hit again. Well, that's also another form of gambler's bias. It's like, no, the probability resets every time you turn the wheel. So, and all these and there's a lot of different biases. We're kind of going over the basic ones today that affect trading. But the effect, the importance of trading psychology is to educate yourself and falling prey to these biases is like one of the main ways that people go sideways with trading psychology, because in the end, it's a system. In the end, what we do over at Algo Factory, and I'm going to put the link in the www.algofactory.tech. I'm going to put it in the comment section of the YouTube, right? So, if you go over to algofactory.tech, you're going to see that there is an online university that we've put together over there, and it's it's I don't know, 50 videos at least, and to get through them takes it properly to get through them and to actually start to implement the process and all that. It takes months and months. I mean, unless you really dedicate a ton of time, it's going to take some time. There's a lot of material in there. And there is a whole section dedicated to trading psychology, and so these biases are all separately addressed in those videos. And we want you to understand that when it comes to technical trading, it's a system. It's a scientific system. It's a system where you actually have to go back in time, and you're going to review how your asset or your currency pair is trading, and you're gonna test it doing something called back testing. And then once you have done that, then you have an understanding of how that particular asset or currency pair behaves. And what you're doing is you're testing your algorithm that you're building. So at that point that if you follow your rules on your algorithm, and you always follow those rules, then you have a statistical degree of probability, right? So it's not like you're always going to win, but that, okay, I have a 1.5 to 1 risk to reward ratio on average, meaning that you put $100, and if you win your trade, you're going to make 150, and you're getting a hit rate of 65% of the time. So 65 out of 100, 6.5 out of 10 times, you're winning that trade, and you're making more than you put in. So now you're profitable. And then you also will know how often your quote unquote trade is going to come up. So, you've gone over a few years worth of data, or depending on your time frame, it might be a few months. And then you can say, oh yeah, I know that during these months, during these times, my trade's going to happen this many times a week or that many times a month. And you can actually plan to know how profitable you might be. And then once you have that system in place, you go ahead and you test it forward with either, you can use paper trading, or you do a very small amount of money on each trade. I like to do the small amount of money. It adds a psychological component, even though it's kind of funny, even though you're putting like $10 on a trade or something, like you'll still have the psychological effect of real money, right? And that'll cause you to, to me, it's a more accurate forward test. And once you've gone through that, and we have more details on how to do this, I'm simplifying it for this video. But once you've done that, you actually have a strength psychologically, because not only do you know how it's behaved in the past, but now you've live tested it and you've seen it operate in the live environment. And okay, this thing is going to work this much time, this many, at this rate. This algorithm is going to have this rate of success. I know that it's going to win 68% of the time, and I know every time I click this button, if I enter $100, on average, I'm going to make $130 or $160 or whatever that is, right? Or if you enter 1,000, it's going to be 1,600. That's called expectancy, when you pretty much have like a base amount that you're putting on your trade. Your position size is fixed, and your percent of your win rate, your risk to reward ratio, you calculate that, and on average, every time you click a button, if you put $1,000, you're going to make $1,650. And then you develop this psychological strength with that expectancy, because you have what I called yesterday, it's kind of like a modified Pavlovian response. You're just because you lost 10 trades in a row, that's going to affect you psychologically, but after a year or two of trading this, that it's sound, and that your system is good. You can analyze why you lost those 10. It might be something to do with the market. As long as you're following your system, though, those numbers should come back around. So this was a beginning course today. Again, it had a lot to do with bias. So it was a little kind of heavier on the psychological aspect of trading. So V, do you have any thoughts before we turn off the YouTube and go over to our private?
No, let's head over to the lab. Listen, all you guys out there in YouTube land, don't sit there, don't wait, don't twiddle your thumbs, don't let life pass you by, don't procrastinate while you just sit there idly by. Join us. Come over, join algofactory.tech, get over to the live labs with us, and let's have some fun. Let's get some learning done.